So I think it is true. I mean, the numbers don't lie, and the GDP is indeed slowing down. And I think what is slowing down even more is the consumer discretionary spending. And I think the real reason for this slowdown in consumer discretionary spending is that the white collar wages in private sector have not done well over last many years. And actually, if you see, the white collar wages in many areas of the economy have degrown in real terms. Last few years, I think growth was sustained by increasing household borrowings and through falling savings, and household leverage in India has gone up pretty sharply in the last 5-6 years. But I think we are coming to a stage where you don't have much room to keep on borrowing and consuming. So I think going forward, I think consumption will grow as and when we are able to increase more jobs and wages.
And I don't think anything dramatic will happen in the near term. So India up until now has been riding because of one engine, which is consumption. The investment cycle has not really picked up for many years now. So are you making a point that the economic pain is here, and more importantly, it is here to stay?
See, I think the capex is improving in all fairness, and it is mostly led by the public sector and its arms of the government. But yes, the consumption growth, which was sustaining growth over last few years, is indeed slowing down. I don't think we should read too much into the numbers which are declared on a monthly basis from the auto industry, because these are wholesale numbers which tell us how much are the dispatches from companies to the wholesalers. I think fact is that the pipeline inventory was very high, and as growth has not come up to expectations, the pipeline inventory is being corrected. I think the key point is that retail sales are also degrowing, but I think the growth is somewhere in high single digits or very low double digits. But this 20-30% degrowth, I think, is in a way misleading, and over time it should correct itself.
Prashant, you are making a case that the slowdown is here to stay. I don't want to get this one wrong, but if consumption does not pick up, and an investment cycle which is already in doldrums and is broken down because the entrepreneur is not feeling excited about spending, so maybe the economic slowdown is here to stay.
See, I think we should, yes, I think for some time I would say growth rates in India should be moderate. It could be 5, it could be 6, but in the near term, I think it is difficult to make a case that economic growth will come up very sharply. I think the good news in India is that the underlying long-term economic fundamentals are intact. And I think if we take the right steps, then I am sure that growth can be accelerated, if not in a matter of quarters, 1-2 quarters. I think over 3 to 6 quarters, I think growth rate should improve. Let us not forget, for example, that as interest rates come down, the EMIs come down and the cars become a little more affordable. And from the low base of current year, I think next year the growth outlook should be better.
So I'll start getting into sectors with you, but before that, let me also throw in the joker in the pack. And the joker in the pack is that world is going to be contracting. Trade war is here, and trade war is here to stay. The Chinese and the Americans are fighting, but it's often said that when the two elephants fight, the grass also suffers. We are right in the middle there.
So I think it's a very interesting question, and in a way, if you see, it is great times for India externally, because what does India import from rest of the world? What do we need? One, we need oil, and two, we need capital, and both are extremely cheap. Oil is low and global interest rates are extremely low. So ideally it should have been a great time for India, I think. But yes, our exports have not been doing well. I think we should not read too much into the weak economic situation globally. For one, the global economy grows between 2 to 3%. I mean, that's it. So it is not that globally economy ever grows at 5-6%. The key to India's export growth is mainly by market share gains, and our share of global trade is extremely low, maybe about 2%. So the key is to take it to 3%, 4% and 5%. And if you look at the IT industry or pharmaceutical generics, they have grown by gaining share, and not because the end markets were growing. So I think it is the external environment, to my mind, is actually conducive because oil prices are low, interest rates are low, and because of this dispute between US and China, it will open up a lot of opportunities for a large country like India, and it gives us an opportunity to scale up manufacturing exports. But clearly there is a lot of work to be done by the industry, by the regulators, by the government, and I think if we execute well, I think it should be quite promising.
What do you make of the recent announcements which have come from the government, one after the other? Maybe they were planned in such a manner, but there seems to be an acknowledgement. There seems to be a attempt to fix the economy. Is this good enough? Are we in for a magical recovery, or this is too late, too little?
No, I think if you look at in India, every difficult situation has been an opportunity, has been a trigger for change. It is a time for self-reflection, and the human mind works much better under pressure when you are not doing well. So I think yes, this slowdown will lead to introspection, and it is good that government is observing and trying to do things. In my assessment, I think few things we could do. One is rightly so, we are lowering interest rates, because lowering interest rates improves chances of improving consumption, because most things in India are now bought on EMIs, and it will also make capital spending a little more economical. I think the second thing what we should do is see what is the missing link. Consumption you cannot revive only by more borrowings. It could be a short-term fix, but it's not a long-term fix. The long-term fix is to take up wages, to create more jobs. And how do you create more jobs? By reviving the private capex cycle. I think, and we need to do two things to revive the private capex cycle. One is we need to resolve these IBC cases very fast. See, think of it this way, which are the most capital intensive sectors? Power, metals and infrastructure. Now, when for an end you are an existing business in these three sectors, and you are faced with the situation that so many steel plants, so many power plants, so many road assets are up for sale. It will take you 3, 5, 10 years to put up a new asset. Then when existing assets are available, then why would you go out and start planning a new plant? So I think only after the existing assets have found a new home will the players say, now existing opportunity is not there, I need to put up new capacities. So I think that is critical, that in the capital intensive businesses, these large number of assets which are up for sale either through IBC or otherwise should be quickly resolved. And unless that happens, it is very hard to make a case for businesses to say I will plan a expansion on my own. It simply does not make sense. And I think the third thing what government must do is, or what should be done, see what has happened in India is our primary capital markets are no more primary. They are primary only in name. So India mobilizes, you can say, about 20 billion US worth of primary fresh equity capital every year through mutual funds and through insurance companies. Now where is that going? Bulk of it is going to meet the selling by existing shareholders. Now this could be government, which is clearly the largest seller of equities. It could be private equity funds. It is existing business houses. It is promoters who are stressed, they are reducing stake, and we know some cases. And it is holding companies diluting stake in subsidiaries. So unless you create primary equity capital, how is it that you will put up a new project? To put up a capital intensive project, first you need to raise equity. I think the real crowding out today is happening in the equity capital markets and not in the fixed income markets. And see what has happened, because of the persistent supply of stock by the government and by other players, and most of the supply has been in core areas of the economy like power, oil and gas, utilities. The valuations of the core sectors are sharply depressed, even in the private sector. So you look at the private sector companies in core areas, they are trading around below book value. Now, if you are a owner of that company, you are not going to raise new equity capital at such low valuations. So I think one thing which could be considered is most of the PSUs, many of them are low leveraged or have some cash. So you say for some time, I will not access the capital markets to dilute. You can either take more dividends or you can sell these companies in some other form instead of coming to the capital markets. If you do that, I think the following should happen. The markets will clearly know that if there is a change in policy, that supply of stock is less to markets, I think the market should come up, and more importantly, the core sectors of the market should come up. This will, I think, create space for private capital to be raised, fresh primary capital to be raised. And I think unless that happens, how is it that you are going to revive the capex cycle? So I think this should be seriously considered.
Okay. The other aspect which I want to address with you is that I was looking at your presentation which HDFC Mutual Fund released at the beginning of the year, and the basic view was that globally central bankers would increase rates, world will start slowing down, and India will see an earnings recovery. But if I look at the scenario right now, pretty much the reverse has happened. Central bankers have reduced rates, India has seen a deceleration, and world has seen an acceleration. Do you think somewhere we are in for interesting times? I don't want to use the word tough, but interesting times.
No, I think what you highlighted just forecast the difficulty in forecasting macroeconomics indicators, and that's what I always say, that while we all love to discuss macro and the outlook, the key for an investor really lies in the micro, and macro is extremely hard to forecast. And what you said is a great point, that when everyone was expecting rates to go up globally, they have actually come down. Again I come back to the same point. If you look at the external environment of low oil prices, see, no one is discussing oil. For 10 years we have discussed nothing but oil. We import capital and we import oil, and both are low. So ideally it is a conducive environment for India, and with these two large countries not trying to redefine the relationship, I think it opens up an opportunity for us, but of course we need to execute. If you look at Vietnam and Bangladesh, they are doing well, these economies, because some of the outsourcing is now shifting there. So I think India has a lot of room to improve things.
The scenario of macro is looking good, but the scenario of macro was not bad even in 16 and 17 and 18. But good macro is not translated into great micro earnings. Right now, the economic slowdown is also here to stay. But ultimately, what markets want, they want earnings. Market are slave of earnings. Where do you think earnings are headed when macro is good, economic slowdown is here, and we have a, I won't use the word disturbance, but yeah, a reboot at global level?
So I think that's a very interesting question. And if you look at last 5 years, India's economic growth was decent, right? But the Nifty EPS growth was 3.5%. So what it tells us clearly is that macro is important, but it is not everything for micro. So in a good macroeconomic environment, your Nifty profits did not grow. And I think the next few years, to my mind, should be the opposite. Macro growth is moderating. Over time it will revive, but I think in the immediate foreseeable future, growth rate should be lower than what we have seen in last couple of years. But I think profit growth in India should do much better. See, the biggest drag on corporate profits was the weak profits from corporate banks, both in public and private sector. And also the capital expenditure was extremely weak in India. I think it's taken longer than what one had anticipated, but I think we are moving in the right direction, and every year seems to be better than the previous year for corporate banks. We have seen quite a few resolutions, some more hopefully should happen in the next few months or quarters. I think even capex is improving. If you hear Larsen and Toubro's last quarter call, it was a very interesting call. And they said that their order pipeline, or I think I read it somewhere, maybe it was not on the call, they said the order pipeline is meaningfully higher than what it was last year. and they have guided for a decent growth in order backlog and a decent growth in order inflow and turnover. I think the key point, however, is that most of this capex is led either by the government or arms of the government. Private capex continues to be quite weak in India. So to come back to your point, I think despite somewhat muted economic growth, I think the profit growth should be significantly better than what we have experienced in the last few years.
What do you make of the consolidation in the PSU banking space? Do you think now this is, indirectly a blessing in disguise for private banks and the 2-3 large corporate banks?
See, I think consolidation is good. It will make these entities better. And see, if you look at a bank, what does a bank, it's a retail bank and it's a corporate bank. So a bank needs to raise deposits. So a bigger franchise clearly makes you more competitive. And on the retail side, clearly technology is the big driver. So the bigger a balance sheet, the bigger the size, the more you can spend on technology. And the technology spends don't get duplicated. If you are 3 banks and you merge them into one, your technology spends will not get cut by 1/3, but a part of technology savings will be pretty large. So I think it can enable you to build a better digital footprint, which is good. You can rationalize some branches, and when it comes to corporate lending, you can devote more resources because you have the ability to write much bigger checks on both quality of underwriting, and it also puts you in a better bargaining power or negotiating power across the table with your large corporate clients. So I think whatever mergers have happened so far, they have worked out well, and I think I see no reason why this merger should not turn out to be a good exercise.
Okay, now before I get into sectors, one very important question in any market is the price at which you buy. Margin of safety, what is in the price and what is not in the price. As a fund manager, what I've always admired and loved about your approach is that you don't look at yesterday's growth, you look at future projections. Do you think markets at these levels are pricing in a lot of bad news? Slowdown is here, sabko pata hai, but is price now factoring that in?
Nikunj, that again is a excellent question. See, the key to investing is not to forecast next 2 years GDP growth, but to figure out what are you paying for today. Is there a margin of safety? And I think there we are in for good news. The environment is broadly good to my mind. If you look at India's market cap to GDP, it is near all-time lows now. So that is telling you that there is good value there. Even if you look at markets on a PE basis, I think there is very good value. See, people are wrongly focusing on trailing earnings. Now when banks are making losses, there is no point in focusing on trailing earnings. But if you focus instead on sectoral PE multiples, price to book value multiples, and even dividend yields, you will find that barring, to my mind, the consumer discretionary and the non-discretionary space, almost all the other sectors are trading near long-term averages or below long-term averages. The dividend yields are pretty decent. The multiples are not that high. Either they are near long-term or they are significantly below long-term averages. So I think there is decent value in these markets, and both at an aggregate level and even more at a disaggregated level. If you look at the entire slowdown, see, everyone is focusing on GDP slowdown and auto sales. Yeah. But no one asked this question, how much does this consumption slowdown in discretionary spending or in automobiles impact the market? It's a very fair question.
What is the weightage of autos?
Yes. So I think we should ask that question. So
let me ask you that question.
So let us look at the composition of the markets. 1/3 of the market is financials.
That's 30% of the Nifty.
Which are broadly doing well for two reasons. One, provisioning costs will come down for sure. The pace can be discussed, but I think by next year we should be back to near normal levels of provisioning and profitability. NBFCs are facing some challenges, at least many of them, not all of them, but quite a few of them. So banks, I think, should be able to gain share. So even in an environment of slow overall credit growth, I think banks per se should do reasonably well because of these two factors. Nearly 1/3 of the market in India, the index weights pertain to global businesses, software, pharmaceuticals, metals, oil and gas, refining. Now just pause and think, what have these businesses got to do with the local economy? Pretty much nothing. Interest rates are down, currency is depreciated. So it is in a way good for them. So that is 2/3 of the market is out. Another, I think 5% of the market is utilities, which again, no, it is not much impacted by economic slowdown. It is more driven by regulations and how many new plants you are adding. So that covers about 70% of the market. Another 10% is capital expenditure, roughly, which is actually doing well. Things are improving. So if you break up the market this way and start asking questions, yes, economy at an aggregate level is not doing great, things are slowing down, but how does it impact? Then you will realize that broadly 3/4 of the market is actually not impacted. That's the composition of the markets. So I think, coming back to your question, I think the markets are offering good value to my mind. But as you very aptly said, that good news and good valuations don't come together. The best investments are made in tough times, and the biggest mistakes are made in great times. So I think these are good times to invest. People should assess their risk appetite, long-term capital, and invest accordingly.
So even though it feels like a bear market in mid and small cap stocks, your view is that it is not a bear market for the economy and the bear market for the earnings.
See, what has happened is very simply growth has slowed down. So I think bear market is, I think it is not the correct way to describe. I would say there is stress there is slowdown in the economy. Consumer discretionary is particularly impacted. Other segments are not impacted. And equity markets, I think, are offering good value. And see, when large caps start offering good value, you are unlikely to get things wrong, because these are large businesses, low leverage. Corporate leverage in India has come down. Most of the businesses which were in deep pain have either been sold, or they are in a state where it does not really matter. The businesses which are there, they are doing reasonably well. I think things are okay.
In last 5 years, we've seen one event after the other. Demonetization, GST, election cycle, IBC. The way in which Indian corporates have done business in last couple of years has changed and will change. The transition is causing pain. How does one really figure out that the new cleansed, better and agile India will start contributing to GDP growth and to the economy? I understand that this is the rate, this is a pain which you will have to bear. But when do you think pain will get over? When do you think real resilience and earnings will come back?
See, I think this is a very tough question to answer, but I think we know that what is missing in the economy, what needs to be done.
Okay.
I think what needs to be done is that private capex has to revive.
Okay.
And when private capex revives, with a 6-month lag, consumption will automatically and sustainably revive. So all questions that we need to ask is what can be done to revive private capex, which has been so weak for so long. And I think there lower interest rates, resolving the IBC cases very fast, ASAP, and I think curtailing the supply or moderating the supply of by the government in primary markets, so that you create room for the private sector to raise capital. See, the supply of primary capital in the economy is limited.
Yes.
It is
20 billion,
which is less than it is 1% of GDP roughly.
Yeah.
That's not a lot.
Fair
So
point.
if that also we start impounding, then how will the capex revive? And please remember, the leverage ratios in core sectors in the private sector are much higher than in public sector firms.
Yeah. Fair point.
So who needs to raise primary capital? It's the private sector core companies. Unless they get that capital, I don't think we will see a sustained revival in private capital.
Okay, you've shied away from autos. Maruti was part of your portfolio in 2014-15. I don't see mention of Maruti, at least in your declared portfolio. Did you sell out of auto because of high valuations or disruption? And my follow-up question is that, do you think the kind of P multiples autos commanded, Maruti went to 40 times, Aisha went to some 40, 50 times, we may not see that in our lifetime?
I think we sold automobiles, or at least I reduced automobiles in my portfolio, mainly driven by valuations.
It was not a call on disruption.
It was at the back of the mind that it will create challenges, but I think in the passenger vehicle market, we think the electric disruption will come the last. It will happen first in two-wheelers, three-wheelers and public transport. So it was there at the back of your mind, but the primary reason was that the valuations had, see, at the peak some of these companies were trading close to 40 times. And we are also aware that a reasonable part of the growth has been sustained due to increased household leverage. And that is telling you that when you are borrowing and spending, and if income growth is not there, you will hit a roadblock. So we were not so optimistic on sustained growth in this space despite the low penetration levels. But primary reason was valuation.
But now that the pain is also reflecting in the stock price, and if you are confident of first investment recovery and consumption recovery, do you think there is merit in revisiting autos?
See, I think the prices have come down, but the multiples have not come down, because earnings will also degrow sharply. And I think I would find, and see, first investment has to revive, salaries have to go up, then we can make a case for sustained revival in consumer discretionary spending. And see, there are a lot of factors at play here, because if you look at the way the passenger car market is evolving, the UV space is growing much faster. Like the scooters gained share massively in the two-wheeler market, the sedans are losing share. And the market shares in the UV space are very different from the SUV space. The UV space, it's a reasonably open market. Around 3-4
players are
there, and each have 20-25% share. So it is fundamentally a different market compared to the
you have a large exposure to utilities. Typically utilities do well when interest rates are on their way down. Interest rates have come down. 8.5 has become 6.5. Utility stocks are not going higher.
So I think value investing works, but it can and it does test your patience, and that is why it is difficult and challenging. And you can see how over in some places it took 3-5 years for stocks to correct.
Corporate banks, you bought them and then it was...
And in some cases it took 2-3 years for them to go up also. But if you look at what happened to NBFCs, you look at what happened to pharmaceuticals, you look at what happened to automobiles, auto ancillaries, they did not correct or go up overnight, it took few years. So I think in utilities in India, I think value is on our side. If you look at the price to book values of these companies, they are lifetime lows. Dividend yields are good. These are good large businesses, dominant businesses, they are not going away anywhere. And interest rates are low. So the room for price to book values to go up is actually significant. I think the challenge here again has been that there has been continuous supply at every price point. And we have to wait either for that supply to get absorbed or for it to get curtailed. But in the end, I think this value will be, because the business value is not at risk. The business values are growing. Lower interest rates means more value for the same profits. What we are debating is when will stock prices go up. So that, I think that's the nature of the animal, that is uncertain. But if value is there, one day we will realize.
Just two follow-up questions. The point what you're making about autos, I think you distinctly made this point on this show in 2015 about pharma. prices had come down, but P multiples are not contracted. But now P multiples have also contracted. 3 years, pharma stocks are just jumping here and there. I've been told that globally generic prices have also bottomed out. Prashant Jain, who was bearish on pharma, is he now bullish on pharma?
See, I think pharma is reasonably valued, I would say. It is not deep value, but I think risk is also limited. And I think Indian companies are very competitive globally, just like in IT. And I think they will grow, profit should grow from here. But please remember, two things are happening. One, your share in US markets is pretty large. And as I said earlier, export growth for a country like India, 80% export growth comes by way of market share gains and not by market gains itself. So when you are a large part of the market, you can see the Indian business in US generics and IT exports both are now growing in single digits. So you can't lose sight of that fact. Number two, if you look at the local markets, for a variety of reasons, the growth rates in local markets in pharmaceutical industry has come down to close to single digits. Earlier this industry used to grow in mid to high double digits, but those times have changed. It could be because of Jan Aushadhi, it could be because of new players, it could be because of one or two new e-commerce websites which are doing business. It could be because of low inflation. So I think I feel this sector is close to fairly valued.
You own large cap IT for a reasonable amount of time now. What did trick for large cap IT was America did much better than what we thought. BFSI business has stabilized and the buyback kicker kicked in. Post the budget, the entire romance to do a buyback is no longer there because there is tax which is at play. What happens to IT stocks then?
So I think, as shareholders, I think we are and we should be indifferent to dividends or buyback.
You buy the business, you don't buy it.
No, whether you share cash by way of dividends or by way of buybacks. So I think we are indifferent, and but yes, to the extent that buybacks are being taxed, it will not make a difference whether you share cash with buy. But interestingly, the payout ratios of IT companies are 80 to 90%. So if you look at, that's a great business, a business that can keep on growing and share with you 80 to 90% of profits or free cash flow as dividends or buyback. I think it tells you about the fundamental strength of that.
Just to wrap it up again, going back to the big picture, do you think for a long-term investor, the differentiating factor would be patience and time? That is what will differentiate whether you are an average investor, a good investor, and whether you've created a lot of wealth or just mediocre wealth.
See, I think equities need more patience than intelligence, and that is time tested. Anyone who has held equities for long periods in a reasonably disciplined and diversified way has done well. And I think it should not be different any time around. If at all there is any correlation between your returns over 3-5 years and investments, it is only with valuations. You forget about the economy, you forget about everything. As long as you don't overpay when you are investing, over 3-5 years you should do reasonably well. And I think in that sense it's a great market.